On June 12, 2026, the biggest IPO in the history of the stock market happened. SpaceX raised $75 billion. Its valuation hit $1.75 trillion. And Elon Musk, on paper, became the first trillionaire in human history. Every news channel covered the headline. Every finance YouTuber covered the hype. But almost nobody covered what was actually written inside the 400-plus page document SpaceX filed with the SEC. Buried in that filing are details most investors will never read. Clauses that limit your legal rights. A corporate structure that gives one person more voting power than almost any public company in American history. And a compensation plan for the CEO that, and I promise I'm not exaggerating, is literally tied to building a city on Mars. I'm not here to tell you whether SpaceX stock is a good buy or a bad buy. That's not my job. And honestly, nobody can tell you that with certainty. What I am here to do is show you exactly what you're signing up for if you buy a share, because almost none of it was in the headlines. Let's go through the filing together. Quick timeline, because context matters here. On May 20th, 2026, SpaceX filed its S-1, the legal document every company must file with the SEC before going public. It revealed, for the first time publicly, real numbers. $18.7 billion in revenue for 2025, but a net loss of $4.9 billion. On June 11th, the IPO was priced at $135 per share. On June 12th, trading opened on the NASDAQ under the ticker SPCX. And by the end of the day, the stock had jumped about 20% there. But here's the detail, almost no headline mentioned. This wasn't just a rocket company going public. In February 2026, SpaceX had already absorbed Elon Musk's AI company, xAI, including the Grok chatbot and the X platform. So when you buy SPCX stock, you're not buying SpaceX, the rocket company. You're buying a combined entity. Rockets, satellites, and artificial intelligence all under one ticker. Let's start unpacking what that actually means for you as an investor. Fact number one. Here's something that surprises a lot of people. Starlink, not rockets, is the actual engine of SpaceX's revenue. In 2025, SpaceX brought in $18.7 billion in total revenue. Of that, Starlink's connectivity segment generated $11.4 billion, about 61% of everything the company made. The space segment, which includes Falcon 9 launches and NASA crew missions, brought in $4 billion. Now here's the twist. Starlink's subscriber numbers have grown fast. From 2.3 million subscribers in 2023 to 10.3 million by March 2026. But the average revenue per user has actually dropped from $99 a month in 2023 to $66 a month now. So Starlink is getting bigger, but each customer is paying less. That's a classic trade-off in subscription businesses. More scale, thinner margins per user. And it's worth understanding before you assume SpaceX just means rockets and Mars. Then there's xAI, the artificial intelligence business now folded into the same stock. In 2025, xAI alone lost $6 billion, and it's projected to burn through $10 billion in 2026, largely due to the cost of building data centers and GPU compute. So when you buy one share of SPCX, you're really buying exposure to three very different businesses, each with a completely different financial story. A profitable-ish satellite internet business, a capital-intensive rocket program, and a cash-burning AI company. Fact number two. This is probably the single most important structural fact about this stock, and it comes down to one phrase: dual-class share structure. When you buy SPCX, you're buying Class A common stock. Each Class A share gets you one vote, but Elon Musk holds a separate category, Class B shares, and each Class B share carries 10 votes. According to SpaceX's own S-1 filing, Musk owns roughly 42% of the company's total equity. But because of those Class B supervoting shares, his actual voting power after the IPO is approximately 85.1%. Let that sink in for a second. Public shareholders, the people who bought stock in the largest IPO in history, collectively have almost no ability to influence a single shareholder vote, a board election, or a major corporate decision. To put this in perspective, Google's founders, Larry Page and Sergey Brin, also use a dual-class structure through Alphabet. But even their combined voting power doesn't approach what Musk holds alone at SpaceX. This isn't unusual in the sense that other companies have done versions of this. What's unusual is the scale, both in dollar terms and in the percentage concentration. Fact number 3, quick history lesson, and I promise this matters more than it sounds. For decades, almost every major U.S. public company has incorporated in Delaware. Why? Because Delaware has the most developed body of corporate law in the country, and its courts are seen as predictable and shareholder-friendly. In 2024, SpaceX did something unusual. It reincorporated from Delaware to Texas. Texas corporate law, specifically under the Texas Business Organizations Code, makes it meaningfully harder for shareholders to take certain actions. For example, to even file a derivative lawsuit against the company, an investor or group of investors typically needs to hold at least 3% of outstanding shares. At SpaceX's valuation, that 3% threshold works out to over $50 billion worth of stock. In other words, unless you're a major institutional investor, or Musk himself, you likely don't have the practical ability to bring that kind of legal action alone. Texas also recently launched its own stock exchange, and SpaceX is dual listed there alongside the NASDAQ, making it one of the highest profile companies to use the new Texas exchange since it opened. None of this is illegal or secret. It's disclosed in the filing, but it's a structural choice that shifts legal leverage further away from individual shareholders. Fact number 4. This next one is, according to several securities lawyers covering the filing, unprecedented for a company of this size. SpaceX's bylaws include a mandatory binding arbitration clause. In plain English, if a shareholder believes they were misled, or that the company or its leadership did something wrong, they generally cannot take that dispute to a jury trial in open court. Instead, most disputes are funneled into private arbitration. The filing also includes a class action waiver, meaning shareholders largely cannot band together to sue collectively. Each investor would have to pursue a claim individually. SpaceX disclosed this directly in its own risk factors, stating, and I'm paraphrasing the substance here, that investors will not have the same legal protections as shareholders of companies subject to standard corporate governance requirements. Here's what makes this particularly notable. In September 2025, the SEC issued a policy statement clarifying that having a mandatory arbitration clause wouldn't by itself block a company's registration from being approved. SpaceX appears to be the first major IPO to actually test that new policy in practice. Whether these provisions hold up, if challenged in court, is still a legal question without a clear answer. Some legal scholars argue federal securities law doesn't allow shareholders to waive certain rights. Others say the arbitration framework was deliberately built to route around that issue. It's an open legal question, and you're an early test case if you buy in. Fact number 5. This fact has nothing to do with SpaceX's official IPO, and everything to do with a much messier story happening in parallel. For years before the IPO, because SpaceX was private, ordinary people couldn't buy its stock through a normal brokerage account. So, a secondary market emerged. Doctors, lawyers, dentists, and other high net worth individuals buying SpaceX shares through private contracts, often from employees or earlier investors cashing out. The problem? These deals are typically private, sometimes secretive, and not registered the way public market trades are. According to reporting from Fortune, this created real exposure to fraud. Buyers couldn't always verify whether the shares they purchased were legitimate. One venture capital co-founder was quoted bluntly asking how many people thought they'd bought into SpaceX, but were actually just funding someone's lifestyle in Miami, and answering that the number isn't zero. Now that SpaceX has IPO'd, those secondary market buyers are entering a lockup period, typically 90 to 180 days, during which insiders and pre-IPO holders can't sell. When that window ends, it will become clear which of those private contracts were legitimate, and which buyers may have been holding paper that was never really backed by real shares. This is a great reminder of something simple. Buying a stock before it's actually tradable on a real exchange always carries a different category of risk. No SEC registration, no standardized clearing, no guarantee the seller actually owned what they sold you. Fact number 6. Here's a detail that almost never makes it into mainstream coverage because it sounds almost out of place. SpaceX's S1 discloses that the company holds approximately 18,712 Bitcoin on its balance sheet. Why does that matter? Because it means a portion of SpaceX's reported financial position is exposed to cryptocurrency price volatility, something most investors would never expect to factor into an aerospace and satellite internet company's valuation. If Bitcoin's price swings sharply in either direction, it can move SpaceX's balance sheet and reported asset values independent of anything happening with rockets, satellites, or AI. This isn't necessarily a red flag on its own. Plenty of companies now hold Bitcoin as a treasury asset, but it's a layer of risk that's easy to miss if you assume you're only exposed to space and satellite business performance. It's a small detail in a 400-plus page document, but it's exactly the kind of thing that experienced analysts flag as a sign you need to actually read the filing, not just the headlines. Fact number 7, SpaceX's S1 makes a bold claim, a total addressable market, meaning the theoretical maximum revenue opportunity of $28.5 trillion. Here's how that number breaks down. $370 billion from the space segment, $1.6 trillion from connectivity, and a massive $26.5 trillion from AI, with $22.7 trillion of that coming from what the filing calls enterprise applications alone. Now here's the part worth sitting with. The businesses generating SpaceX's actual revenue today, space and connectivity, represent under 7% of that headline $28.5 trillion number. The AI segment, the part carrying most of that valuation narrative, is the part generating the least actual revenue right now. To be clear, a large total addressable market isn't a red flag by itself. Every growth company presents an optimistic TOM. It's a standard part of how companies pitch their future to investors, but the gap between addressable market and actual revenue is exactly the kind of number that's easy to get swept up in if you don't pause and ask, how much of this is happening today versus how much is a bet on the future? That's not a criticism of SpaceX specifically. It's a pattern worth recognizing in any IPO that leads with a $1 trillion TAM slide. Fact number 8. If there's one single risk factor that SpaceX itself ranks at the very top of its own filing, it's this: Starship. As of the filing, SpaceX had completed 11 Starship test flights, but had not yet completed a single commercial payload launch. The space segment alone is spending close to $3 billion a year in R&D on Starship development, with zero revenue currently offsetting that spend. Why does this matter so much? Because almost every part of SpaceX's future growth story depends on Starship actually working at scale. The next generation of Starlink satellites, expansion into mobile and orbital services, and, according to the filing, even the company's ambitions around orbital AI data centers. SpaceX's 12th Starship test flight was scheduled for June 2026. Essentially, right around the time the company went public. The first productive commercial payload launch isn't expected until sometime in the second half of 2026 at the earliest. So a meaningful part of what you're buying when you buy SPCX stock is a bet, not a certainty, that this next generation rocket, which hasn't yet generated commercial revenue, will work as planned.